Hello and welcome to Property Insights. I'm Neil Harding.
And I'm Mark Ashworth.
Today we're going to be looking at the property market and the market update for September 2023. We're going to be looking at inflation, we're going to look at house prices and what that means for mortgage products and property investing. So we're going to kick things off with a look at inflation. So today is 20th September 2023 and inflation numbers have just been announced. I was reading in BBC News earlier this morning actually that inflation for August is running at 6.7%, which is down from July at 6.8%. So a relatively small change, but it is down. And probably more importantly, it's actually down versus economists' expectations for the UK. And I think that's probably way more important. We want inflation to come down. The government's targeting 2% inflation as the long term, and I think they've said that they want 5% by the end of 2023, which is what they're gunning for to get the economy under control. That was a little bit of a surprise for me actually. I know from a personal point of view, every time I fill up the car with fuel this month, it seemed like petrol prices had increased. So you'll be filling it at the petrol pumps.
I think that the officials who look at the inflationary rates are keen that it does actually drop. I don't think they really care how much by, but it just gives some certainty to the market that the rates are dropping. And I also think that does actually affect the long-term swap rates on mortgages and interest rates, which obviously affects the most of us, and that's what, savers and borrowers are keen to sort of see where the metrics are on that.
Yeah, the inflation news is so related to interest rates, which is so related to mortgage product rates. So Mark, you and I have been speaking to our mortgage broker quite a lot over the last few days. We've been struggling to find mortgage products that we like the look of. I think 2-year fixes in particular. I mean, I spoke to my mortgage broker this morning and couldn't really see a 2-year fix mortgage product on the market that not just I could cope with or could stomach. It just didn't stack and wouldn't pass stress tests of the bank, let alone my own, for remortgage purposes, let alone a purchase. So what's your experience of speaking to your broker?
Yeah, I had the same conversation in particular, not necessarily with new purchases, but remortgages. Landlords trying to find products that are going to replace the existing products that they have on those properties. They are trying to get a 75% loan to value on a certain rental income, which just doesn't stack. So the broker's having to say, I need you to find 10 grand, 20 grand, 30 grand to put into this property to bring the loan to value down so that it meets the stress levels. Invariably, they're being pushed to 5-year loans, which obviously are fairly high at the moment, and nobody really knows where those interest rates are going to go. There was some quite interesting statistics that I saw about interest rates over the next 5 to 10 years coming down quite significantly. Can't remember where that data was. Apologies. If I find it, I'll pop in the description. So that's really interesting with regard to those 2-year properties. So even if you're purchasing and trying to find something for 2 years that would maybe ride out the next couple of years and then remortgage again in 2 years' time, that's proving to be difficult. So therefore, you're either finding that people are maybe not buying properties, which potentially will put those prices further down over the next, let's say, 2 months, 3 months. There's already been a drop in house prices, which we'll come to, I'm sure. So yeah, I think the whole market at the minute is kind of very much sort of on rocky ground, should we say.
For mortgage products at the moment, 5-year fixes seems to be where it's at. So I've been looking at some deals with my mortgage broker. Got some notes here of the couple of deals products that I've been looking at. One is with the Mortgage Works, which currently has a 5.49% interest rate on a 70% loan to value, and that carries a 5% product fee, which is quite high. They're finding ways, lenders, to get people over the line on stress tests to do, I guess, responsible lending, fine, but 5% fee on a £150,000 mortgage, £7,500, it's a fair amount of money.
I mean, the swap rates between those lenders compared to what we were seeing a couple of years ago is interesting to look at, because obviously the bank needs to make a margin. But how much margin was it making when the interest rate was 0.1% and they were having their mortgages at, I mean, let's say 3%, 2 or 3%. We're talking about buy-to-let properties here rather than residential. So that's depending on what they've borrowed that at, what is the would you consider the margin to be there? 1%?
Yeah, perhaps. I'm not sure. It seems like they're making some super profits on those sorts of deals at the moment because of the uncertainty.
They're making those profits now, yeah, and they're making them with those arrangement fees, because 5.9 or 6%. So what is the swap rate? Amount of money that the banks it's costing them to borrow that money from other banks to lend it to you. If they're making a 1% margin and then they're still charging you a 5% fee.
The 75% loan to value product with the Mortgage Works currently is 5.99%, and that's got a 3% fee. For the numbers that I was running on the particular mortgage that I was looking at, actually it made very little difference on the particular mortgage balance. I think it was about £500 or £600 difference over the period of 5 years as to which was more economical for me. And then just to mention also Paragons, they were featuring at the top of the tables for lending rates at the moment. So they have a 5-year fixed product, a number of them actually, and there are favourable rates if what they call green mortgage products. So if your EPC rating is an A or a B, but obviously that's that's a minority in reality of rental properties out there. But there are favourable rates for anyone that does have an EPC rating property for energy performance certificates of A or B. For everybody else, the mortgage rate was 5.8% with a 3% product fee on a 75% loan to value. This is all within a limited company, by the way, or 5.3% on a 75% loan to value in a limited company with a 5% product fee. So again, that fairly ugly 5% product fee is there again, which is quite heavy. But anyway, just to give you an idea of where we are, and clearly those rates are 2%, 3% more than they were only a year ago. So let's have a look at what's going on with house prices. ONS data, Office of National Statistics data, is released quarterly, so more often than not. So in the meantime, to get monthly data, you can look at things like Rightmove and the asking prices. It's not sold data, but it is asking prices, which is still a decent lead indicator of what direction house prices are going in. We've looked at the house price data for Rightmove. August 2023 had a monthly change down 1.9% on the month, which is quite a swing. The annual change to August 2023 across the UK was minus 0.1%. So very nearly, dare I say it, flat really, hardly any change at all. First time buyers, the monthly change on the houses that are being purchased by first time buyers was a decrease of 0.9% and an annual change of 0.2%. Then those buyers that are at the other end of the buying chain, so top of the ladder, as Rightmove call them, the monthly change there was down 3.4% and annual change was down 0.1%, but that monthly change was quite large. But I think it's indicating that it's the lower end of the market that's probably holding up on house prices more so than the larger 4 or 5 bed plus size properties in the more expensive parts of the UK.
Yeah, and the other thing just to mention, which we had done so on last month's market update, is not to forget on my Rightmove alerts, I've seen a lot of reductions. So if you're paying less for a property today than you were 3 months or 6 months ago, with inflation running as it is, then effectively you're getting a fairly good discount, potentially up to 10% or even higher.
We've also looked at This Is Money, and there's an interesting article in there from Hamptons who have published some data. They've actually produced a prediction, a forecast. Read into this what you will, but I actually
it's in someone's opinion, of course.
It's someone's opinion of what might happen over the next 4 years. Interestingly, Hamptons have predicted that average rents will rise by 25% over the next 4 years. So, average annual increase in rent by, what would that be, 6% roughly per annum? I mean, that's huge. Especially when you think over the last 2 or 3 years, with a lot of landlords exiting the market, and there have been quite a lot of landlords exiting the market, I feel as though rents have increased by at least 20%, if not more than that, on my portfolio. Do you feel the same?
Absolutely, and I think that this is a significant change. I think that landlords are affected just as badly as tenants because, as we were talking earlier about interest rates, I've got an interest rate product on one of my buy-to-lets at about 1.8%, which will be going, when it comes to the end of its life, to 6%, and I'll have a 5% charge on top of that.
Yeah.
So therefore, those rates and those increases will also pass through. But one thing to note, with inflation, there are some things, a few things, which aren't necessarily affected by them. Traditionally, rents always go up in line with inflation. So if he's talking about 25% over 5 years, which is 6% a year, and the current inflationary rate is 6.7, and it has actually been up to 8, 9, 10% in the last year or two, and actually there are a lot of commentators which believe that real inflation is more like 12 to 15%. Those figures stack up. That makes total sense.
Yep.
And that's what everybody's got to understand. It's not just rents are going up because landlords want the rents to go up. Rents are in line with inflation and with, they're driven by the market. They're driven by wage prices. They're driven by supply and demand. They're driven by all these other factors. They're not driven by what the landlords simply want to charge.
Yeah, it's a really good point. It's a new inflationary level increase, which is what rents have typically historically gone up by.
The only lucky people that may come out of this will be landlords who own properties outright without products on, that have got good long-standing tenants and who are prepared to accept lower than market rent. I mean, I wouldn't suggest that younger landlords or younger people with property businesses that are using leverage and using mortgages, the rental prices will have to go up in line with what the market is, particularly if they start getting rid of their stock.
Hamptons have also forecast that average house price growth across that same 4-year period will be 5.5%. So 5.5%, not per annum, 5.5% total across a 4-year period. Do you agree with that, Mark, or do you think that sounds about right, or what would the reasons for that 5.5% be? What roughly just over, say, 1.5% growth per annum in house prices for each of 4 years doesn't sound like a huge amount of growth. Given inflation, for example, what do you think the reasons for that might be?
I don't think that there would be hardly any growth at all in house prices. I mean, I think that the whole flat thing and going down, I mean, I'm not sure for how long, 5 years, did you say?
4 years.
4 years. I can't really see that the house price growth is going to go anywhere as inflation is, as long as inflation stays where it is at the moment. I don't think it's going up. The only time when house prices, I think, will start to increase again is when mortgage interest rates come down and are more affordable. I'm not quite sure about the residential market because people are sitting still. We've had such a massive impact in the last year on house prices, an enormous impact, that's affecting the sentiment of the country, the sentiment of whether people want to actually move, whether it's a right time for them, whether they're going to actually buy that first property, or whether they're going to move from a bigger or smaller house. People are finding it difficult to sell bigger houses. So without the whole chain of property being available, it breaks down somewhere. I don't even think it's going to be as much as that.
You heard it here first, as I say. Okay, so that's the market update for September 23. Thanks for watching. We hope that's been insightful and look forward to seeing you on the next video. Please do add comments, like and subscribe to our channel. It's massively appreciated and really helps us. Until next time, thanks.